Good afternoon. Welcome to this, our third of 3 training webcasts on the Low-Income Housing Tax Credit Pilot Program. My name is Dan Sullivan. I'm the Deputy Director of Multifamily Development here at FHA in HUD headquarters. I'll be speaking this afternoon on mortgage credit requirements for the tax credit pilot. But first, we'll be starting with Tom Goad on my far right. Tom is the Director of Tech Support, and we'll be talking about valuation issues. Following Tom, Hillary Atkin in our environmental office will be speaking about environmental issues and particularly about SHPO notification requirements. And then our last speaker today on my left, David Wilderman, also in our tech support division, will be talking about architectural requirements and repair escrow administration requirements. So what we'll do is each speaker will present comments, and then we'll have time for questions and answers. If you have questions, please send them by email to Carolyn Kalin at HUD.gov. That's carolyn.a.kalin@HUD.gov. And I believe the show will have the overhead has the web address for the spelling. With that, let's turn it over, and Tom, if you could begin our presentation.
Sure will. Thank you, Dan. In terms of valuation issues, I think you're all aware that the question is how involved is the HUD appraiser in terms of the valuations and evaluation review, and that question is now on the screen, and the answer is we're not really involved in terms of the review process. That is designated or given to the designated underwriter that's responsible for reviewing the appraisal report. However, there may be circumstances where the designated underwriter may need some assistance, and at that time the HUD review appraiser on staff can be brought in to help in the review of the rent comparability studies and review of the operating expenses. And as you notice, specifically where the operating expenses fall outside what would be considered the norm by at least 10%, then the assistance of the HUD appraiser may be required also. There are some challenges that need to be met in terms of the review, and but some of those need to occur before the application is submitted, and specifically among those I've highlighted here, and that is that there needs to be some correlation between the third-party appraisal report, income and operating expenses, and the performance-based contract. This all needs to happen prior to the submittal of the appraisal to the program center. Another aspect is all pilot projects should have rents at least 10% below market for each type of unit, and that's particular criteria has resulted in some confusion in the field to the point that on July 10th we did issue on our frequently asked questions in regards to the 202 program that some clarification on that and what exactly it meant. But the threshold for eligibility requirement is that the actual rents being achieved must be at least 10% below market, although tax credit ceiling may be slightly higher. And we can go into that more if you like in the question and answer. Also, if you have additional questions on that, be happy to answer those if you'd email me. Timing of the MAP application, the Section 8 contract renewal, that's very important in that, and obviously that we want at least a minimum of a 20-year contract on the Section 8 HAP contract, and make sure the underwriting the income expenses is consistent with the HAP contract before submitting the application. So you can see all of those bullet points are somewhat interrelated, that a lot of the legwork and a lot of the coordination between the HAP contract, the appraiser that submits the valuation estimate, all has to be, and the underwriter, all has to be accomplished prior to submittal of the application to the program center. a few of the qualifications or requirements of the appraisal, and essentially in terms, it's a 223F, that it has to be in compliant with section 7.17 of the MAP guide. And in that section, the appraisal is consistent with evaluation in two facets. One, for example, at criterion 3, a hypothetical market value must be estimated, in which market rents, market operating expenses are utilized. However, in that the HAP contract or the Section 8 will be used in support of the overall debt service payments, that its criterion 5 must have also an independent section with schedules that are prepared to include the operating expenses, income, etc., that are applicable to the HAP contract. Let me go back a second here. Okay. And of course, at market value, the appraiser must ignore the Section 8 contracts. Tax credit exempt bonds or low-income housing tax credit rents when determining the market value. Well, that's strictly the market value that we're talking about in terms of criterion 3. Also, to be consistent, at criterion 3, there should be a market-derived capitalization rate used. However, if 90% of the more of the units at the complex have support from a project-based Section 8 or Section 8 contract or low-income housing tax credits, then we have made some exceptions in that regard in determining an overall capitalization rate to use in arriving at a value at criterion 3. And one of those is that realizing that it's difficult to extract for those unusual properties that have unusual rent and operating expense characteristics, that we have allowed under this program that the overall rate be built through the band of investments.
Tom, if I could just reiterate your point on this. So basically, we want a market value, pure market for criteria 3, and analysis in criteria 5, the debt service, would be actually how the project would operate. For those projects that have, in the pilot, that have 90% or greater project-based Section 8, we could consider a favorable impact by the band of investment analysis, recognizing the subsidy. So that's the one exception, and limited just to the pilot program and just for those that have greater than 90% project-based Section 8.
Thank you, Dan. And that kind of moves into the next slide, which is on criterion 5, that explains the difference between the determination of a value at criterion 3 and one at criterion 5. And essentially the difference is, as Dan mentioned, is that at criterion 5 we want the rent that we used in terms of sizing the debt and repaying the debt. And in terms of determining the applicable rents where the tax credits are involved, we also need the 2264T must be included within the application. And again, I just mentioned the 92264T, and this is kind of an analysis that you're all familiar with in terms of arriving at a rent utilizing the T form, where we have a combination of Section 8 rents and low-income housing tax credit rents. And it provides an example there between where the estimated market rent under Section 8 is at a level of $850, where the tax credit rent is at $350, the maximum tax credit rent. Well, the total $850 rent could be achieved under this scenario by a combination of both the Section 8 rent payment and the obligation based on the tax credits at $350 per month. So again, I'd like to reiterate that, as I said at the outset, that the the responsibilities of the HUD reviewer in terms of the appraiser is fairly limited unless some difficulties are encountered by the designated underwriter at the local program center. Any questions? I see no more questions, so I'm going to, or no questions. I'm going to move to Hillary, and she's going to explain the environmental reviews.
All right, thank you. Good afternoon, everyone. As Dan mentioned, my name is Hillary Atkin. I'm an environmental specialist here at HUD, and I'm here to explain how the environmental reviews will be conducted for the program. Basically, there will not be too many differences. And here, let me move to my first slide here. As the slide states, the environmental review will still be conducted by the HUB environmental reviewer, which is usually the appraiser, and it will follow the usual requirements for 223F projects. However, we did create a few twists to the process to help streamline. Okay, our first twist has to do with the Phase 1, Phase 2 contamination reviews. Phase 1 ESAs, as augmented by the vapor encroachment screen, must contain no environmental issues that would require a Phase 2 or a remediation plan. In other words, the Phase 1 must indicate that there are no RECs and no VECs at the site. In addition, the HUD environmental reviewer must concur with this determination. So we just ask that you carefully review the Phase 1 and make sure that their conclusions regarding RECs and VECs seem accurate. The second twist that we have here is that a site visit by the environmental reviewer will not be required if two conditions are met. The first is the condition we just discussed, that the Phase 1 identifies no RECs or VECs on the site, and the HUD reviewer concurs with this determination. And the second is that the site is in conformity with environmental laws and regulations as listed in the sample field notes checklist and in section 9.5 of the map guide. And the HUD environmental reviewer must make sure that these laws and regulations are met. On to our next twist. And this is the more complicated twist that we've created for this program. Basically, we're allowing lenders to initiate consultation under Section 106 of the Historic Preservation Act with their state historic preservation officer. So HUD still remains legally responsible for any determinations that the lender makes with the SHPO, but the lender gets to initiate this consultation process. And what that involves is the SHPO sending a letter, or I'm sorry, the lender sending a letter to the SHPO describing the project, what will be done on the site, whether there are any historic properties in the area, or if the project itself is a historic property, and allowing the SHPO the opportunity to comment on whether they think there will be an effect on a historic property. SHPOs will have 30 days to respond to this letter. If they do not respond within 30 days, the lender must submit to HUD a document that certifies that the lender gave the SHPO 30 days to respond and a response was not received. Then the HUD reviewer needs to take a look at the letter that was sent by the lender to the SHPO and just make sure that it was adequate. So this letter that I'm referencing, we do have an example letter that lenders can use, that you can give to lenders. It was included in the appendix of the training documents for the program and is also available on the SharePoint in Word form for you to download. HUD will begin to participate in this consultation if there is an adverse effect determination, there's disagreement between the SHPO and the lender, there's an objection, or there is potential for foreclosure or anticipatory demolition. And there is an example of the letter that we sent to the SHPOs in the appendix of the guide if you want to see this language. And if you have any questions about what any of these things mean, feel free to ask. We have also included several appendix documents to give guidance on the 106 consultation process in case you have questions, including sample consultation letters, which I referenced earlier, a Section 106 process checklist and Section 106 info sheet. I do want everyone to keep in mind that lenders cannot initiate consultation with tribal historic preservation officers. So this consultation initiation process is only for state historic preservation officers, not tribal historic preservation officers. Finally, there is another complication to this SHPO process. For those hubs that were in the initial pilot program for this program, the letters to the SHPOs have been sent out. However, the rest of the SHPO letters have not been sent out. At this point, we ask that you do not have lenders initiate consultation process until those SHPO letters have been sent. When they are sent, we will upload the letters to the SharePoint and let everybody know that it's okay to let lenders initiate consultation with the state historic preservation officers. One more twist to discuss today, and this also has to do with SHPO consultation. The FHA has determined that permanent financing processed under Section 223F of the Low Income Housing Tax Credit Pilot Program for properties that were recently constructed and occupied with no associated rehabilitation or new construction has no potential to cause effects as described in 36 CFR 800, and thus have no further obligations under Section 106. Basically, what this means is if the project is a 223F project, it was recently constructed or occupied, and there is no rehabilitation or new construction, we have predetermined that this has no potential to affect a historic property, and thus does not have to go through the 106 process. One example of a project that this may apply to are 3-year waiver projects carried out under the pilot program that do not involve building rehabilitation or new construction. So if this is applicable, we ask that you include the no potential to cause effects memo in the environmental file. And that memo was uploaded to SharePoint. I don't believe it's available in the appendix to the guide documents, but it is available on SharePoint for you to download and put in your environmental file if it's applicable. And my final slide here is just a listing of documents that I've referenced that are useful to the SHPO process that we are using for this program. These are all available on the SharePoint, and most of them are available as appendices to the guide document. That's all for me. Do we have any questions? Okay.
Let's actually, we were going to take a significant break here halfway through, but since we're running ahead of time, I'd like to go in and at least start the mortgage credit session, but I would like to pause and just give, say, 2-minute timeout for people to send their questions, and we do want to use this time to get any questions answered or to for us to receive any that we don't have answers for, so we can consider them and get timely answers out. So let's just take a 2-minute break and give people a chance to send their questions to Carolyn Kalin at HUD.gov. Thanks. Well, we haven't received any questions, so we'll go ahead and continue on with our presentation and start on the mortgage credit portion. First several slides, particularly of my presentation, will be fairly generic, that we do this on any FHA application, whether it's using tax credits or not. Then we'll talk a little bit about some of the specific distinctions about looking at who a principal is in a tax credit transaction and what differences there are. So if we can get the first, my slides, the mortgage credit slides up. And I don't know if those are up yet, but I'll just go ahead and go through them. First question really is, what is the underwriter responsible for in conducting the mortgage credit review? And really 6 C's, things to think about. First is evaluating the character and credit worthiness of the borrower and the development team. Fundamental mortgage credit question, do we want to do business with these folks? Because it's the pilot program, the idea is we'd like to see the easier transactions and the ones where it should be a yes. There's no question about that. From time to time, there'll be problems in borrowers' credit and, for instance, defaults or bankruptcies. And those aren't out-of-hand disqualifiers, but they certainly set the bar, and the lender will need to do their thorough analysis on the character and credit worthiness of the borrower and development team. One nuance with the tax credit pilot program, since it's limited to 223F, we typically would not have a general contractor. However, in some cases, there'll be significant repairs, even though they don't go above the threshold limit, where the architect requires a general contractor. And so the processing guide available on our website gives some specific details about the scope of the general contractor review, and it's a much more streamlined version of what we would do, for instance, under a 221D4 analysis. Second C is capital structure of the deal, debt versus equity, and is the capital structure within the program limits as far as loan ratios, as well as risk tolerance. Part of that defining the capital structure would be describing the escrow requirements. This can get complicated in a tax credit deal because FHA will have escrow requirements, and then the tax credit syndicator may have some tax credit requirements. Third C is cash sources and uses, and 2 points under analyzing the cash structure of the deal. One is to make sure the sources and uses balance, and secondly, to make sure there's cash available for the transaction to close. And one of the things that's come up and we've had questions on is the repair escrow required to be funded at closing? And the answer is yes. We will allow a deferral of 20% contingency requirement, but we expect the cash to be funded at the time of closing. We have seen questions come up, and we will consider waivers. We may or may not grant them, so check on that at the concept meeting stage. But if, for instance, the syndication proceed timing is such that the pricing on the tax credit syndication is significantly and materially impaired by requiring all of that to be funded up front, there's a lot of pressure and requests on the department to reconsider that. Our policy is really we want 100% funded at the time 100% of the loan proceeds are funded. That is an initial final endorsement, but we could consider a waiver if facts supported that. Next C, and on my third slide, and the slides dated today, compliance. And so historically, HUD's analysis has always been a processing and compliance approach. And really, we want to focus on risk management, evaluation of the risk, and underwriting. But nevertheless, we still expect the forms to be filled out correctly, there to be a certification approving the release of banking information, making sure that the 2530 or app system has been navigated successfully, and the 4 magic questions on the 2013 SUP certification. And those basic fundamental program requirements need to be met. Next one, C, is construction draw processing and tracking. And so that, of course, is more true for the 221D4 program, but as well and David will speak to the repair escrow. So there are some mortgage credit underwriting functions in that process. And then the last C is cost certification. So we got two C's there. Cost certification is not required for 223F transactions where the loan to value is less than 80%. That's an FHA program rule, as well as consistent with HERA's exemption on tax credit deals from going through cost cert. For those transactions that do exceed 80% loan to value, there is a 2205A supplement short form cost certification required, and that should be analyzed as well at the end of the repair process to make sure that the value, that the cost substantiates a value for the loan to value above 80%. So some more C's of underwriting, complete. So we want to make sure that the mortgage credit submission as well as the other application exhibits are complete. A couple of things to comment here. One is that the mortgage credit binder should be bound separately from the rest of the application. This is important because there's privacy sensitive information and financial information that should not be released, and not only not released, but it shouldn't be accessible other than the people that need to know. So the lender certainly needs that, and they need to submit that in a separate file, separately bound from the rest of the application exhibits. The related point, and some lenders have been concerned that some borrowers are concerned, well, you know, they don't want to disclose their financial condition. And so such borrowers should actually think about equity transactions. If we're loaning money and if the lender's making a loan and HUD is being asked to insure that loan, we really do require complete disclosure for all principals. It's a basic fundamental concept, and if the lender is negligent in this, that's a problem. I mention it because we've seen some pressure or questions from borrowers and lenders. Well, we don't really want to disclose our credit. And in that case, well, FHA doesn't want to insure the loan. And further, if the lender tries to slide it in, that would be a problem. We would dial 1-800-911-LQMD. So we want to make sure we have complete disclosure, but at the same time, it needs to be bound separately, and it's not a bad practice to mark it not subject to FOIA, for instance, so that we don't end up publishing their borrower's credit report to the local newspaper. Other completeness items, organizational chart and identification of principals. We'll take a break here in a minute, and then we'll talk about principals and who is a principal, but fundamentally we want to see an org chart of the structure of the ownership entity. I would also note credit reports. They need to be correct for instance, for individuals under the residential mortgage credit report form, and for businesses, a business credit report and current. Next C of mortgage credit review is consistency. We want to make sure that the credit reports, the financial statements, the real estate owned schedule are consistent with each other. Now, in the past, we've had problems where the lender has gone over diligent in this, or the HUD office has been overly picky, and there's been a debate over, you know, a minor discrepancy due to a reporting period of one document versus the other. And so we're not looking for that level of consistency, but really these financial statements, the REO schedule, the credit report needs to tell a consistent and coherent picture that makes sense. And again, it's the underwriter's job to tell that story. The lender's underwriter needs to present that, and then the HUD staff needs to make sure that those documents are internally consistent. Yet another C of mortgage credit review is coherent. The story needs to be coherent, and that plays out in mortgage credit review. For instance, if we say they have great credit, but there's a lot of troubled history in terms of negative credit history, maybe a problem with ballooning debt on the real estate owned schedule and no plan to recapitalize the debt, or that the loan to values are upside down. They're thinking about a short sale on many properties. So that's not consistent, and it's really not a coherent story for us in terms of a good credit review. We really want to see the underwriting narrative demonstrate that the mortgagor and principals are creditworthy, experienced, well capitalized, that they have sufficient liquidity, net worth, and are going to pose a minimal risk to the department. Make sure that the real estate owned value on the real estate owned schedule and the real estate value on the balance sheet really demonstrate the experience and financial strength that is being presented. Next C is convincing. Are risks fully mitigated? And so every deal has risk, just because we can't tell the future, and that's part of why we charge mortgage insurance premiums. Are those risks explained and mitigated? Strengths and weaknesses, risks and mitigant need to be spelled out. And then the last C is current. Is the information current? And we have specified currency dates for different documents in our map guide, and that needs to be updated. Sometimes that's a problem because things will change, and then just a supplemental statement by the lender is adequate to explain those changes. I'd like to take a break, and before we go into the next segment where we'll talk about creditworthiness and mortgage credit review as it relates to who is a principal, we'll have a org chart, sample org chart of a sample transaction, and then take more extended time for questions. But at this point, I'd like to take a 2 to 3 minute break, and that will give you a chance as well, if you have any questions on what's been presented, to send those to us. Thank you. Welcome back to our session. I'm out of C's on mortgage credit review, so but we did get some questions in during the break, which we'll answer at the end. So you still have time to send in questions if you have any on mortgage credit. For the second half of my presentation, I wanted to spend some time specifically on things that are more focused, instead of general mortgage credit, on issues that have come up in the tax credit pilot. First slide I wanted to go through is just a quote from Map Guide 8.3 D2, and if that could be on the screen, I just wanted to read this. For purposes of evaluating creditworthiness and acceptable counterparty risk of principals, the underwriter must identify those individuals and entities which, if they encountered significant financial or legal problems, could undermine the success of the subject property. I actually haven't ever come up with anything particularly original, but that part I did and wrote that into the map guide, and it's really at the heart of who is a principal. If they get in trouble, will that undermine the success of the subject property? Having said that, for purposes of HUD processing, there's really three levels of who can be classified as a principal. Historically, we went to the regulatory definition in the 2530. As well, we want to focus on the creditworthiness of who those principals are that really control the transaction, and if they got in trouble, would be undermine the transaction. And then lastly, with the publication of the new closing documents, the regulatory agreement has a provision in number 50 that requires two signatories, and those parties take responsibility if there's fraud or monies taken from the project that they weren't entitled to. So those are the three levels of who is a principal, and we'll go through those on the next slide with with a sample org chart for a tax credit deal. So the first level of analysis is the borrower, the single asset mortgagor entity, and we'll call this new project limited partnership. So the next entity we'll look at is the managing general partner. This, in this case, Senior Affordable Project Housing Corporation, which is a 501c3 nonprofit entity. Then working with that nonprofit is a development entity, an administrative general partner, also a principal. Then there'd be a 99.9 something investor partnership, a limited partner. And then sometimes we'll see a special limited partner that comes in certain circumstances, and we'll talk about that in a minute. In our sample, we named our manager Mr. Joe Harris. He is the development entity and really controls this administrative general partner. And then he would be acting on behalf of a family trust and trustees. So who are the key principals? Well, first one really is this general partner. Anytime there's a general partner, we would expect them to be a key principal, and for purposes of the financial analysis, we're going to want to see their REO schedule. Likewise, in this case, Joe Harris is clearly the key player because he is the developer and the one with the experience. The organizational documents and their resumes will demonstrate this, and in this case, we're assuming that Joe Harris really is the driving person in putting the deal together. The 2530 analysis would go, first off, certainly to the single asset mortgagor entity. Secondly, to the general partner, and indeed to both general partners. Because Joe Harris is a key principal in the definitions that are in the regs, he would be subject to the 2530s as well. But the investor limiter partner could submit a certificate in lieu of a 2530. The reason for that is that they're a passive investor, and under HERA, the department was somewhere between directed to and given authority to accept certificates in lieu of a 25/30, that this investor is purely investing as a passive investor. If there was an identity of interest between the limited partner or any of its members and Joe Harris or the members of the nonprofit board, that could be a case where we would actually require a 25/30. But in most cases, that's a non-identity of interest entity, and we would not require a 25/30. The form of that certificate is on our website, and I believe in our session last Monday, Kathy Soroka spoke to the specifics of that form. So as I mentioned, Joe Harris, he is going to have to fill out the 25/30 or go through the app system online. Another word about the limited partner. If they're approved, have done GSE transactions and have experience, or if they're a publicly rated entity and their financial reports and credits are a matter of public record, that generally will suffice for the more thorough mortgage credit review. The MAP guide tells us that if the tax credit syndicator is identified, if there's a syndicator in the deal, the lender's underwriter will need to give us a brief overview and analysis of that entity. Typically, the tax credit syndicator is an investor intermediary with only a limited ongoing obligation to the tax credit rental property. Accordingly, we wouldn't expect to see an REO schedule for the syndicator or investors, and unless they had an identity of interest, they too would be considered a passive entity and able to submit the certification in lieu of a 25/30 review. However, the syndicator's liquidity track record, their asset management and monitoring capability, and their history of performing on its commitments to provide equity is a material issue for the mortgage credit analysis. So those are some specific things that affect tax credit deals that don't affect other FHA transactions. Just to reiterate the comments about the certification in lieu of a 25/30, it applies to any entity that has just limited liability. And it doesn't matter if it's an LLC, a corporate investor, or a limited partnership. It applies to investors and affiliates investing in the tax credit projects, and the syndicators as well, if that syndicator is not a general partner. And then one last point is about special limited partners. If you remember on the organizational chart we had up in the upper right-hand column was a special limited partner. We don't always see those, but from time to time investors will want such an entity. And basically that entity has the ability to come in some tax credit transactions and take over a general partner role in the events of non-compliance or default under the operating agreements for the tax credit partnership. Historically, that's been a problem for HUD because we require a TPA approval for the transfer of physical assets through asset management. Because of the time required for that, the arrangement has been made in tax credit deals to allow basically pre-approval at the time the tax credit transaction closes, to allow for a limited period of time the special limited partner to come in, and then after 120 days HUD would either need to approve them through a TPA or require a different entity. The thinking there is that the department's in no worse position because that special limited partner wouldn't come in unless there were problems with meeting the tax credit compliance requirements, which could put the loan in jeopardy. Next slide, I wanted to talk a little bit about the capital structure of the deal and specifically some thoughts on making FHA work with tax credits. Two documents specifically, the subordination agreements and then the repair escrow. David Wilderman will talk in a few minutes about the repair escrow administration, but a couple of thoughts about structuring the tax credit deal to be consistent with the FHA terms. From time to time, local local authorities, in fact it's typical, will want a use agreement, and in many localities will require that those use restrictions, those covenants running with the land to survive foreclosure. Because FHA requires our mortgage to be in first lien position, that creates a problem. But we also have the ability to waive on a case-by-case basis to allow that an exception to the first lien position for the FHA mortgage and allow these use restrictions to prime the FHA first lien. That can only be approved case by case, and in cases where it's necessary to accommodate the requirements of the local entities providing tax credits or other affordability restrictions. The HUD directors have authority to waive that, and the lender submitting the application needs to specify that as a point of a waiver. And generally, we will approve those on tax credit transactions for the public purpose of allowing those use restrictions to survive even if the FHA loan is foreclosed on or sold in a note sale. Any modifications to the subordination agreement need to be cleared by HUD headquarters before doing it in OGC, but then the expectation is once that's revised for that jurisdiction, that HUD field office, that the same form would be used going forward. And so then subsequent similar changes would have to come to HUD headquarters OGC. Another point of, that comes up in the capital structure of the FHA loan in tax credit deals is often there'll be subordinate or secondary financing. The terms of that secondary financing are limited in some cases by regulation, in other cases by MAP guide requirements. And I wanted to go through a couple of them. First one is no performing seconds. 24 CFR 200.85 actually is in the regs that you can't have a performing second. From time to time, we will process a regulatory waiver. We've granted a couple over the last 2 years, but it is a regulatory waiver that the commissioner, FHA commissioner, has to sign. And so, while we'll generally want to cooperate if there's significant public funds coming in to supplement the FHA loan, that is a reg waiver to have it be a performing second. That is, payments due every month as opposed to just a surplus cash note. Another provision we sometimes see is a request for debt to have a balloon payment or a bullet payment prior to the full amortization period of the FHA loan. While that's not a regulatory requirement, it is something we would generally discourage and not want to do, and would not want to grant a waiver for that. The loan should be fully amortizing with the consistent period of the first mortgage. Having said that, the golden rule applies here, and that is whoever puts in the gold should make the rules. Now, typically the FHA loan is the majority of sources of cash, but if there's material amounts of other public funds and significant affordability, we can have and will waive the balloon requirement, and as long as the risk is mitigated, that when it comes due, first off, it's in a subordinate position, so they're not likely to foreclose over the first. And then secondly, the idea would be we would do this for other public entities that are not likely to have a motive to destabilize the property due to the maturity of a balloon payment and could reasonably be expected to cooperate in a workout. Other provisions, we generally, if there's subordinate financing, we do want to see that at least some cash flow goes to the owner, and generally no more than 75% of the net cash flow should go to service the second mortgage. The reason for that is we want to have the owner to have a financial incentive in the loan. So cash flow is one of the C's of mortgage credit underwriting. Another thing to consider in the capital structure is compliance with the program limits, and in the 223F program, which is the vehicle for doing FHA loans under the pilot, we limit secondary financing combined with first mortgage financing to 92.5% of the loan to value if the source of the secondary financing is a private party. In most tax credit deals, at least most of the ones we've seen, typically it's a public entity, and there is no loan to value limited in such deals. There are other limits and more stringent in the 221D4 program, but that's outside of the scope of the tax credit pilot. The last point I wanted to talk about is repair escrow administration, and an issue comes up on tax credit pilot deals because typically we're seeing part of the repairs are funded through the mortgage proceeds and then part are funded through tax credit syndication or other public sources. And so the question arises is who controls those funds? And here the golden rule really does apply. FHA is in first position and really needs to control the release of those funds and make sure that the work is completed, as well as we have control over workout situations if there are significant cost overruns, change orders, or problems in the repair process. David Wilderman will talk in a minute about some of those details of repair escrow administration, but a general comment is that HUD would definitely want to cooperate in terms of reasonable consultation with the other sources, as well as notice and opportunity to cure problems. And then I would note that the underwriter really needs to have a detailed schedule, construction progress schedule on what work is going to be completed, so that it's thought through and that we would minimize the chance of cost overruns or problems during the repair process. So those are my notes. I couldn't think of any more C's, and I didn't want to, I wanted to cover, though, at least some of the basic issues that come up in all mortgage credit underwriting, and then as well cover some of the specifics about who is a principal and who is not a principal for tax credit pilots and what the exceptions are to the 2530 requirements, as well as we've covered some of the boundaries around secondary financing. I believe there were some questions, and so we'll take a minute to get those on the screen, and then we'll turn it over to David Wilderman. So are there questions on the screen from the emails? So I'm not seeing any questions on the screen, so maybe we can just take another 2 minutes to see if those questions come up, and maybe take a break here for 2 minutes before David then goes into his presentation. Welcome back. We did receive a couple of questions. We received 2 environmental questions and then 1 question that David Wilderman's going to cover on the next segment. Hillary Atkin, could you answer the 2 environmental questions for us?
Sure. So the first question we have is, you discussed the role of lenders and HUB staff with respect to state historic preservation reviews. What is the role of HUB staff with respect to tribal historic preservation reviews? So basically, the role that HUD staff will have with respect to the tribal historic preservation consultation is the same as it's been all along. HUD staff needs to initiate consultation with tribal historic preservation officers. So while we're providing a streamlined process for consultation with state historic preservation officers, we still need that government-to-government consultation with tribal historic preservation officers if their interests may be affected. And HUD actually has a great tool on its ATEC website, which is through the CPD page, that can tell you if there are tribes which may have an interest in your project location. But as I said before, this process with consultation with tribal historic preservation officers will remain the same. Our second question is, how would the environmental review be completed for projects not located in pilot HUB offices? So the program has extended to all HUD offices, is that correct?
So all jurisdictions are covered by the pilot. However, there's 9 of the 17 hubs are actually processing hubs.
Okay.
And so the designated underwriter would need to make arrangements for the environmental review. As Hillary noted, in some cases, no site inspection is required. In cases where the project is located outside of the geographic jurisdiction of the designated underwriter's HUB office, they would either need to arrange for themselves to travel to the project or contact the local originating HUB and ask them to provide that service. And we do anticipate that coming up from time to time. That's how we would handle it, really a case-by-case basis.
Okay.
Well, with that, the next question, we did receive a third question, but David Wilderman in his section has a slide on that. So we're going to turn it over and ask David Wilderman to talk to us about architectural requirements and rehab escrow administration.
Well, thank you, Dan. I think, as most of you know, when we're talking about construction in this context, we're going to be talking about 223Fs and what I think have been dubbed 223F heavies. So we're going to, in terms of construction and architectural exhibits, we're going to be looking at all the usual 223F exhibits. They still remain, but there are going to be some key differences. One of the key differences will be that the review of the A&E documents will be by the designated underwriter and not by the HUD architect, except in some selected cases where there may be a particular issue of where the designated underwriter requires some assistance. In addition, we're going to be able to spend more money. That's what makes it a heavy. Up to $40,000 per unit will be allowed, and in those cases where repairs are in excess of $15,000 a unit, we will be requiring a licensed architect to manage the job. There may be some nuances there. We'll come back to those in a moment. In addition, we want to pay attention to accessibility issues, not only with respect to the Fair Housing Act's design and construction requirements, but also, since we may be seeing a lot of Section 8 transactions here, we're going to be talking about Section 504 and UFAS, and that's a bit more complicated than the Fair Housing Act. And also, since we're talking about tax credits, we're going to be talking about ADA, because tax credits are considered a state program, and state programs are subject to ADA under a different title, not as a public accommodation, but because it's a state program. So that means that ADA will be a larger consideration than we often find it to be in ordinary underwriting of F transactions. Another key difference is that the construction time that we will allow for repairs, which is ordinarily only 12 months for non-critical repairs, will in many cases be extended because of the larger scale of the work that may be in some transactions. So let's talk about the project capital needs assessment for a moment. The purpose of a CNA is to identify the condition of the property, its recent repairs and the cost of those, and to identify immediate repairs or critical repairs that may be required right away, as well as a laundry list of repairs that may be required within the next 12 to 24 months, other repairs that may be of the nature of property improvements that ownership wants to see made. And then, of course, there may be remedies for accessibility deficiencies that have to be undertaken. For the most part, there's no real change in our guidance for how a CNA will be done. We do have a new mortgagee letter coming out on this topic, which in fact was signed this morning, Dan. So it will be published shortly, and we will be using that guidance in this pilot. And the qualifications of the person doing the needs assessment are important. You will need to have either a licensed architect or one of our normal needs assessors who have skill and expertise in this field. In addition, we want to make sure that we have covered our accessibility issues, and this is emphasized in the new mortgagee letter. If there are remedies that are required, these will need to be described in a corrective action plan, and these will have to be a portion of the work required for the project. This next bullet here is actually an error. I believe it's supposed to be Housing Notice 2012-12, which is in fact a reference to the 3-year waiver and the role of PCNA reports in 3-year waiver deals, which of course are newly built and shouldn't have much in the way of repairs required, but they may have latent defects, and we want to make sure that we are protected from latent defects, and so reference should be made to Section 13 of that Housing Notice 2012-12. So let's talk about the limits on rehabilitation. As we noted, the cost limit is $40,000, and that is not a number that is subject to any cost adjustment or high cost factor. It is an absolute limit, applies all across the country. And when we say, we may spend up to that sum, but we also want to make sure that we're not dealing with substantial rehabilitation. And one of the possible ways that we might trigger substantial rehabilitation would be by the replacement of more than one system. Now, this word system has had a long story in the FHA experience, and we've had varying definitions of it or applications of the same definition over time. I think we can credit Dan with this list of bullets here that we're now using as the description of systems. There are 5 of them. There's the building envelope, and I believe that's actually spelled with no E, so that must be the Dan Quayle Dictionary of the English language there.
I apologize, David, but the idea is the building envelope is the combination of the siding, the doors, windows, and the roof. So
Right.
That's one building envelope.
Right, and so that's essentially the entire exterior of a structure. Then there's the structural system, which of course is the bones of each building, and then the mechanical divisions: plumbing, electrical, and heating, ventilating, and air conditioning. And so what does it mean to replace one of these systems? Well, it means that you replace more than 50% of any one of these, and that 50% is of cost as opposed to a list of items. So let's take the building envelope as an example. If you replaced more than half of the roof, or half the cost of replacing all roofs, and perhaps half the cost of replacing all windows, and then you threw in all new siding, you would probably come close to a point where you were replacing that one system. It's highly unlikely that you would ever come close to replacing half the structural system, and it's pretty unlikely that you would find that circumstance to be true of plumbing or wiring. It's possible that you might do that with HVAC. So this is a very broad definition of systems. It means, I think, as a practical matter, that we will rarely, if ever, encounter the sub-rehab threshold on the two systems basis.
And David, before you go on to the next slide, did you want to address the issue of what's included in the 40,000?
Yes, sir. That is on the next slide,
That's
actually.
great.
So let's talk about cost for a moment. The cost include, or may include, and I think the operative word here is may, certainly all the hard cost. We can also include general conditions and overhead for a contractor, and profit. That's particularly true if we're talking about an unaffiliated third-party general contractor. But here's the question: what happens if it's an affiliated general contractor? Are we still going to allow a profit? And I think in this case we are not laying down a hard and fast rule, but certainly the designated underwriter needs to be aware that it would be possible to have excessive compensation to the sponsor if we permitted, say, a 10 or 15% profit on the rehab cost, as well as a 15% development fee on total depreciable cost.
David, before you go on to the next one, let me just address this issue of may, and I would say must. So it's not a may. The rehab costs do include overhead and profit, as well as general conditions. It's really at what's in the contract is what defines that 40,000. We have seen a number of inquiries come up and go right to the 40,000 limit, and if that repair cost does not include general conditions and overhead, that does need to be put into that rehab cost threshold. And if that including those items cause the repair per unit amount to go over 40,000, then the project is not eligible for the pilot. It needs to go as a Section 221D4 sub-rehab or other financing.
Beyond that, rehab costs are mortgageable, but only to the extent that they fall within the normal $6,500 limit for 223F repairs, adjusted by the appropriate high cost factor. In addition, developer fees of up to 15% of depreciable cost may be permitted when you have an 85 to 87% loan-to-value limited loan. If the operative limit on the loan amount is 80% loan-to-value, then the proceeds can be used for any purpose. And the distinction between mortgageable cost, non-mortgageable cost, soft cost, and so forth will be laid out on the wheelbarrow. Now, what exhibits are we going to be asking for related to the general contractor? We have a threshold of $15,000 per unit as a point at which we would like to see an architect engaged by the owner to supervise construction. I want to pause here for a couple of minutes and talk about how this may actually work. And also about the next bullet, which is that we're looking to the architect to provide us with advice or a recommendation about whether or not a general contractor may be required. So what exactly will be the documents that the architect would be agreeing to for his participation in this job? Well, it's going to be this thing we call an AIA B108 contract. This is an owner and architect agreement, and while a lot of the construction, our construction and A&E people are pretty familiar with this, others may not be. And I want to suggest that Article 1 is probably the crucial portion of this document, because it's the one where it's the article where you will, the owner and the architect will actually describe the parameters of the job. And I would even suggest that the designated underwriter might want to make sure that the language that would go in Article 1 here, 1.1, would be something that would be discussed at an early date in the process, probably at a concept meeting or a concept telephone conference. And so what would we want described here? Well, we would want to know whether or not drawings will be used, and so what kind of, what level of drawings. Clearly, since we're talking about what amounts to moderate rehab in many cases, we may not want the usual scale of drawings or scope of drawings. It's conceivable that you could have a job where you might be slightly over the $15,000 limit at $16,000 or $17,000 or something, and not actually need an architect. What kind of a circumstance might that be? I would suggest that we look at our cost estimate form, and you'll see the list of various trades. And what's true about the trades listed is that for the most part, each of these items represents a separate subcontractor. That's not always true, but it frequently is. And so what we ought to be able to do at an early stage is identify how many of these trades are involved. And if we find that there are numerous trades, then we're more likely to be interested in seeing a general contractor on the site to manage and coordinate all of these people on the job. In addition, with respect to drawings, how do we decide whether we want drawings and which drawings might be desirable? I would suggest that one of the key indicators here is whether or not dimensions are important. You can envision a job, for example, where we only check a few of these items on the project cost estimate, such as maybe appliances, carpet, and HVAC. And we might have all of these things might be replaced as they are, that is, with the same size, in the same locations, and so forth. So there's really no change in dimensions, and you can envision a possibility that the cost here might exceed $15,000. And in that event, it would be reasonable to me not to require an architect.
Not to require a general contractor. So
well, perhaps not an architect. If you're not making any changes at least no drawings.
Right. So the program requirement is for repairs above $15,000 a unit. The borrower must engage a licensed architect, and David is suggesting some conditions under a waiver. In addition to the dimension issue, for instance, if a lot of the work is merely replacing appliances, for instance,
right,
that could be a circumstance. But generally speaking, any time there's a repairs, greater than 15,000, we expect an architect to be engaged, and that architect may or may not decide to have a general contractor required.
Well, since we don't expect that these construction documents are going to be reviewed extensively by our staff. In fact, the designated underwriter is expected to undertake this. So the question of whether or not a general contractor is engaged is something that we would like to hear about from the architect. But in terms of our review of that, we need to be aware of some of the factors that might influence that. And in my judgment, the primary factor would be the number of trades involved. And then with respect to drawings, in which, whether or not we have any sketches and how extensive those are, that's primarily a function of dimensions and whether or not we are moving things. We might have a kitchen remodel, for example, as a standard item for most of the units in a project. And if that remodeling involved relocating the appliances, the sink, and installing an island where there wasn't one before, then clearly dimensions are important, and they would be important to the review of the accessibility requirements as well. So there are other requirements, and plans and specifications. I think we've pretty well dealt with that. Clearly, the more complex the job, the more likely you're going to want to see plans and specs. Relocation. This is also related to the extent of the work and whether or not you're moving things. If you're taking the housewife's kitchen out of duty for a week, then you're going to have a relocation plan, and that's going to need to be very specific, and all the people that will be managing it will have to be identified. The owner-architect agreement, we've talked about that. The key part is Article 1, the property insurance schedule, the 2329. This is a standard item with a HUD transaction, and we will need replacement cost for the buildings identified on the 2329. Lead-based paint and asbestos and other specialty reports are issues that the designated underwriter may ask for assistance with from the architectural and engineering staff. Repair escrows. We will be using some of the controls of the type that we normally see in a D4. But here I want to point something out, and that is that in a tax credit deal, we really have a strong ally in the tax credit investor and the syndicator, because we're in the same boat, essentially. And the reason for that is that the cost of repairs is an important part of the depreciable basis, which of course is a material consideration in the value of the credits. So if you're in a canoe with a partner, you want to make sure that you're paddling together. So we want to communicate with the syndicator or the tax credit investor and make sure that we are cooperating on managing construction and inspections and not working against each other. Again, we're going to rely upon the architect to be signing certificates of completion and request for disbursements. So the architect may, depending upon the scale of the job, be looking for an independent inspection firm to back him up, and in that case, that would be something we would want to require. The lender will bring the title work up to date with respect to lien waivers on each draw, and will obtain the written certification that the work has been completed as shown on the 2464. I think we've covered a good bit of these items as well. HUD inspections will be taking place as they usually do on an F at 35, 65, and 100% completion. It will be the lender's job to approve and disperse funds, and our HUD sign-off, inspection and sign-off is required before the final disbursement. Dan mentioned earlier that there would be that all of the cost of construction should be escrowed. There's the 20% completion assurance that should be escrowed as well, but we are flexible about that because we do have the tax credit investor involved, and that's some additional security. And it's also true that their provision of funds may be later than the initial closing. So what makes our A&E analysis successful? Well, the deal we agreed to do and closed on stays closed. The work is completed. It comes in at or under cost, and the quality of the work assures long-term physical integrity at the project. So, Dan, that's my section.
Okay. Thank you, David. Now, if there are questions beyond the questions that we've received today, and there are a couple more, please contact Lynn Worley. Her address, email address is posted, or her direct line is 202-402-5210. We do have several questions that have come in, and we'll wait for a few more minutes if you want to send those to carolyn.a.kalin@hud.gov. It looks like the first question from Seattle, Hillary Atkin gets to answer this one. Another question about tribal notification.
Okay, the question is, we have just confirmed with our regional environmental specialist that tribal notification is not required under 223F. Why did the environmental specialist discuss this under the pilot? All I really have to say about that is that it is required if there are effects under a 223F project. I'm not sure what the regional environmental specialist is referencing when they said that there is not, and perhaps I should speak with somebody offline regarding this question.
Maybe the commenter could contact Hillary as a follow-up, and if there is some change to the policy, we'll issue that on a Q&A. Next one is a David question about, or maybe me, if the general contractor is an entity affiliated with the borrower, is it acceptable to eliminate the builder's profit from the mortgageable rehab cost and the $40,000 program limitation, but still pay the profit from the syndication proceeds after completion of the rehab? And I would say that one needs a follow-up and some discussion. I have an answer here, but it may not be the right one. So we'll put that on a Q&A as a follow-up. If there are no more questions, we'll just give another 30 seconds to see if there are any. And as we just give another minute, just wanted to say thank you to Tom Goad and to Hillary Atkin and David Wilderman for stepping in and doing the training today. I hope this series has been helpful. I'm told it's available on the HUD webcast archives. And we'll see if there are any other questions. Okay. Well, thank you so much for tuning in today. And again, do let Lynn Worley know if you have any follow-up. We will send out on a subsequent Q&A and conversation with the field and lenders on our next regularly scheduled biweekly conference calls, the answer to the question about if there's an affiliated relationship between the general contractor and the developer, how the profit would be treated within that $40,000 limit. Thank you and good afternoon.